Hi, I'm James Robinson. I manage money for a living, and this is my stock pick of the week. This video is on the balance sheet for a company called Alphabet, which most of you will know as Google. The symbols are GOOG or GOOGL. It doesn't really matter which of those two stocks you buy. One has voting rights and one doesn't, but you're unlikely to buy enough shares for your voting rights to matter. Usually I also do a video on dividends for a company, but since Google pays no dividends, I won't be doing that video. In terms of why I do a video on the balance sheet, well, first of all, as a value investor, Graham and Dodd would tell you that you should be buying companies if you can you're buying net for where you're buying the stock for less than the net cash the company has. That doesn't really happen much anymore. But the reason I look at the balance sheet is because I want to get a sense for the company's ability to withstand bad times. If a company has a ton of debt, it's very hard to withstand bad times. If a company has no debt and no cash, again, it can be hard to withstand bad times. But if they have some cash in the bank and they have no debt, then they're in a pretty good situation should things turn against them. Obviously, we're in a recession right now. Obviously, the economy is tough. Interest rates are going crazy and inflation is going crazy. And so companies are going to struggle. If you're the company that has no debt and has a lot of money in the bank, you're more likely to survive and more likely to come out stronger on the other end as some of your competitors who have too much debt wither away. Or potentially you could even buy those competitors at a discount, taking advantage of the economy. So we think balance sheets are worth spending some time on. I know most of you don't, but you should take a look at this stuff. The very first thing that I always look at when looking at the company's balance sheet is I look at the cash on marketable securities. Marketable securities, by the way, are basically securities that you could sell very quickly, typically in a few days, and they're counted as cash on the balance sheet because effectively that's what they are. So you can see in 2002, the company had virtually no cash, no surprise there. The company was founded in 1998. But today it has about $140 billion in cash. That's a tremendous amount of money. In fact, it's actually so much money that I consider it a red flag. We know, because I've already talked about in this video, that this company pays no dividends. What you haven't figured out yet is that the company doesn't really buy back much stock either. And the result is they've got this tremendous cash hoard, but I don't think they need it for their operations. I think they should be returning it to the shareholders. Ideally, we'd love someone like Carl Icahn to come in and force management to do that, like he's done with Apple and with so many other companies in the past. Unfortunately, that's very unlikely to happen. The two founders of this company have Class A stock, which has 10 votes for every Class B stocks shares votes. And as a result, they really do control the company and there's nothing you can do. So I don't expect them to pay dividends anytime soon. I don't expect them to buy back stock anytime soon. I wish that they would. But what we know for sure is that the company is so well run and it makes so much money that we just have to accept that the money's going to go in cash for the time being. And the good news is they don't seem to be frittering it away or wasting it. The money that they are reinvesting back in the business, which we're seeing wealth management and the wealth creation, is doing well. So while it's a red flag, they have so much cash, there are worse red flags to have. Like everybody on YouTube, I'm trying to grow my subscriber base and grow my channel. Obviously, that happens by getting new subscribers. So if you've made money on my videos, or you like my videos, or you're learning something in my videos, please take the time to subscribe. Please also drop me a line letting me know where you live. I like to keep track of where my subscribers come from. Here you can see a map that shows you where my known current subscribers are. Finally, if you want to follow me on Twitter, my handle is @RobinsonStocks. I often will talk about stocks that I'm buying or selling. More importantly, I'll give you articles that I think are important or headlines that I think are worth reading. So follow me on @RobinsonStocks. The next thing that I like to look at when analyzing a company is current liabilities compared to current assets. So the definition of a current liability is money that you either currently owe or will owe within the next 12 months. The definition of a current asset is money that you either have or will have within the next 12 months. And we like to see a gap between those two. Obviously here the gap is enormous. The company has current liabilities of, call it 55 billion. And they have about 180 billion in current assets. And obviously 140 of that is pure cash. So they have about $40 billion in receivables on top of that. So this company is in extremely good shape. Its ability to pay its receivables, they can pay it many, many times over. There's nothing to be concerned about here. One thing to talk about is you see the current liabilities are going up. Anytime a company is growing, it tends to have its current liabilities going up simply because as it grows, it has more employees. That's money they have to pay. They typically have more facilities. That they have to pay rent going forward for those facilities. Oftentimes there's new equipment they have to have. And the result is current liabilities are going up as a sign of growth. What you hope you will see is that the current assets are going up at least as fast, and more importantly, that earnings are going up faster than the rate that the current liabilities are going up. And all of those are the case with this company. So Google or Alphabet is in great shape when you look at current assets compared to current liabilities. Current ratio is the ratio of current assets to current liabilities. And you can see that for much of its history, Google has been in the top 10%, very clearly in the top 10% of companies. It's now in the top 25% of companies. Again, they've got plenty of money. They've got plenty of current assets to pay their bills going forward. Nothing to be worried about here. The fact that this number has come down is not really relevant. The company still has plenty of money. So here you see a debt analysis. Red is the total long-term debt that the company has, and blue is the total current liabilities. Again, debt falls into two categories. A current liability is one that you owe in the next year, and a long-term debt is money that you will owe, but you don't currently owe this year. And you can see that the company's really taken on a tremendous amount of debt. It's gone from about $17 billion in debt to about $65 billion in debt over the last, I call it 6 years, 5 or 6 years. That's a tremendous amount of debt. But one of the things that's happening here is when a company takes money in around the world, rather than repatriating that money to America and potentially having to pay taxes on it, they leave that money in the other environment where it was earned, and then they simply take out debt to approximate the amount of money that they would have gotten from those other companies. Also, for the last 5, 10, 15 years, it's been so cheap to borrow money that why wouldn't you borrow $70 billion at 3% if you could? So I suspect that is a trend that will start to moderate now as interest rates get higher and higher. But I'm not bothered by the fact that they have $70 billion in debt, because as you looked at when we did the operations analysis, you saw that debt as a percentage of operating income was irrelevant, very, very tiny. That's a trend that's likely to continue, and we'll talk more about that as these slides go forward. The reason that I care about how much debt we have is because I care how much interest payments we have. Interest payments are money that we have to pay even when times are bad. The bank doesn't care, they want their money. And so interest payments can really destroy a company in the bad times. Now, in this case, you can see that if you just looked at the interest expense chart, you'd be very, very nervous. You'd see that it's gone from 100 million to 350 million in just a very, very short period of time. And plus that giant jump there, that's obviously very troubling. But when you look at it in the context of the company, really, if you look at the next slide, the blue line is still the interest expense line, and the red line is interest income. And you can see the company has, 5 or 6 times as much interest income as it has in interest expense. Again, when you have $140 billion in cash, that allows you to do that. So the net interest, there is no net interest expense for this company. They have net interest income. And by the way, I expect that number to become much, much larger going forward, because some of that money actually truly is in cash, and they perhaps were getting nothing from the bank for that money. And now they're going to start getting 2 or 3% from the bank for that money that they just hold in cash. Well, 3% of $140 billion is $5 or $6 billion. So I expect that will be about a 5 or 6% increase in the company's earnings. They don't have to take on debt at the current 7 or 8%. So I literally expect that the company's interest income versus interest expense is going to get wider and wider, and actually be a significant profit center for the company just based on how much cash they have. So this is looking at interest coverage ratio, and that's the amount of money that they make relative to the amount of interest that they owe. I like to see as an absolute minimum the company has 1.5 times the income they need to pay their interest expense. And what's funny about this chart is they have about 295 times the income they need to pay their interest expense. So again, it looks like there's not a very big gap here between those two numbers, but it's a fantastic gap. The reason that the chart looks the way it does is because at one point they had like 2,000 times as much income as they needed to pay their expense. And that you can see in that first year in 2010. And that kind of changes the slide a little bit. But generally, this would be a company that have 6 or 7 or 8 or 10 times the income they need. And these guys have 300 times the income. So again, what you see here is that the company is in fantastic shape relative to debt. Debt is not a problem for this company. One of the ways that you can look at debt which puts it in context for the way the company is performing is to look at years income to pay off long-term debt. So if we know what a company makes and we know what the debt is, we can calculate how many years they'd have to forego giving any money to anybody but just the bank and paying off all the debt, or the bondholders and paying off the debt. And you can see that in the case of this company, it's much less than a year. So they could pay off all of their debt in less than a year, and then the next year have no debt on the books. That gives you a sense of that this company's in really, really good shape in terms of the debt obligations. I've already shown you this slide in the last video, but just to give a sense of it again, because we're talking about balance sheet and we're talking about debt, this is interest expense as a percentage of operating income, and you can see that it's about 1 or 2%. So the interest expense is 1 or 2% of the operating income. It's not significant. It's in fact it's less than significant. If it wasn't for the fact that I always talk about this category, I wouldn't be talking about it here at all. It's really fascinating that we can get a company that is growing its earnings this fast, that has this little debt, and we can buy it at 18 times earnings. It's a really good opportunity, and one that I hope you'll avail yourself of. I think it'll be very, very profitable. Another thing I look at is debt to equity ratio. And you can see here the debt to equity ratio is clearly in the top 10% of companies, where it has always been. This company has far, far more equity than it has debt. And that shows up in this chart. So one of the reasons we worry about debt is because debt can bring the company down. There's no real scenario here where interest expense or the debt is going to hurt this company, which makes it very, very, very safe, which means that we should be willing to pay a premium for it, especially given the growth the company's been able to achieve in terms of earnings growth. So that does it for the balance sheet. The balance sheet for this company is spectacular. They have $140 billion in cash. They have net positive interest income relative to the interest expense. They have every chart, they're in the top 10%, and the debt they could pay off in less than a year. Long story short, the balance sheet of this company is spectacular, and it's one of the strong reasons why I advise you to buy the company.